Welcome back, everyone. This is Mike Eklund and Colton Tickle with the third quarter 2024 market update from Financial Symmetry. Thanks for those who've been listening to our previous updates. We've been doing every quarter for the last few years. We'll walk through in about 10 minutes kind of what happened last quarter, as well as some things to think about as investors as well. The first thing I wanted to make sure is disclaimers to make you understand that this is not personalized investment advice for your situation. If you have any specific questions and you are a Financial Symmetry client, please reach out to your advisory team. If you're not a client, then you can contact us and we can talk a little further about how we can help. So with that, I wanted to first talk a little bit about kind of what happened over the last 1, 5, and 10 years through September 30th, 2024. This is the long-term market summary. For those of you who have listened before, we typically don't include, a month or 3-month results because we want people to focus on the long term. But what you can see over the last year, U.S. and international stocks and real estate all did very well, returning between 25 to 35%. Now, that's not normal, but it was very strong returns over the last year. And even the bond market, which has struggled the last few years, returned over 10%, 11% for U.S. bonds and close to 10% for international bonds. Now, the results are a little more mixed over the last 5 and 10 years, and we'll talk a little bit about that on a future slide. But this is a little more helpful kind of what we saw over the last 12, 5, and 10 years. With that, I'll hand it off to Colton, who talked a little bit about the S&P 500.
Yeah, just like what Mike had mentioned, the last decade has been dominated by the S&P 500. So this is a slide from Dimensional that shows 5-year returns of the S&P 500. And although, like I mentioned, the last decade has been dominated by it, you can take a look back there at prior periods to see where they've actually underperformed other markets. So like Mike is highlighting there, the 5-year period of 2000 to 2004, the S&P actually had negative performance for that 5-year period. So I think it's important to kind of highlight to avoid that recency bias and in sticking to a diversified investment strategy to help reduce that concentration risk and achieve those long-term full period returns listed there on the right-hand side.
Well, that's great. Thanks, Colton. And one of the reasons why we like this is because it does compare the S&P 500 to the dimensional indexes. A lot of our clients will use the dimensional funds or DFA funds, we like to call them. So we think it's a better representation versus the S&P 500. And as you noted, Colton, even though it's done well over this full period, which is close to 45 years or 35 years, the S&P 500 was only the middle performer versus the other indices as well. So with that, other topic that we wanted to address is the stock market has done well this year. I mean, the numbers we showed there last year have been very strong. We've been hitting new highs recently. A lot of people will think, well, is this a good time to invest? But the research actually shows that returns the next 1, 5, and 10 years are still strong after we reach market highs. So just because the market has done well, it doesn't mean this is a time to sit on the sideline and wait for a correction or a bear market. We feel like time in the market is more important than timing the market. So with that, I'll pan it back over to Colton, who will talk a little bit about kind of how those returns don't go in a straight line.
Yeah, just like what Mike had mentioned there, looking back kind of the bumpy road to the market's long-term average, it's pretty volatile throughout annual returns if you look back. So typically the market has returned about 10%, but actual returns aren't linear. Many of the years are higher or lower than the average, and historically 1 in 4 years are down markets. It's actually pretty interesting to point out that only 6 of the last nearly 100 years of returns have been within 2% of that 10% average. So it's more important, to Mike's point, staying in your seat, sticking to an investment strategy that align with your goals.
Yeah, no, that's great, Colton. I think the analogy I always like to hear, it's like investing in some ways like riding a roller coaster. The biggest risk you have is getting out of your seat during the ride. And I think this is no more example than this slide. There's going to be a lot of good years and potentially bad years as well. But the longer you stick to it, the long-term results are very strong. So with that, I wouldn't be a market update in October of 2024 without an update on the presidential election. And for those of you who have watched previous webinars or market update webinars from us, you'll notice that this is the same slide we showed in July, and that's on purpose because we want to remind folks that even though the election is a few weeks away here, regardless of who wins, either Democrat or Republican, it has not had a material impact on the market results. I always like to say the market doesn't care about red or blue. They care about green, and green is earnings. And so as noted on the slide, shareholders and companies and management adjust depending on who is in office. And so it's more important to stay in your seat and continue to invest and not make irrational decisions based upon, who is in office. So I'm sure more to come on that, but that is, hopefully a good representation of historical market results by the different parties.
Yeah, taking it to kind of another topic of mine, especially over the last few months with the Federal Reserve actually cutting rates for the first time in many years. The chart that's shown is actually from JP Morgan, and it just shows the long-term federal funds rate along with projected paths going forward. So taking it from here, the market expects them to continue to reduce rates in the coming years, going down to about 3% by 2026 or so. And I think this kind of just highlights the risk of owning too much cash versus bonds. So as your returns on cash, they'll drop with those future rate cuts. And I think one of the many reasons why bonds have historically had higher returns than cash.
No, that's a great point, Colton. Everyone has been excited about the yield they've been getting on their bank account, but now with rates starting to drop, I would expect that the bank account interest rate to continue to decline, which wants some more, comments on the benefit of owning bonds over cash for money that you don't need here in the very, very near future. So moving forward on the next slide, we wanted to mention something on investor behavior. Morningstar does a really good study once a year that looks at what they call Mind the Gap. And what they're doing is looking at the actual investor returns versus the investment that they're investing in. So that could be a mutual fund or ETF or the different type of investments. And what they find through what some would call the behavior gap is that the typical investor trails the investment by a little over 1% per year. Well, you might say, well, it's 1% a year. It's not a big number, but over 10 years, that's over 15%. That is your return is reduced by that behavior gap or poor timing, one could say as well. So this, we wanted to show you to reiterate the importance of having a disciplined investment strategy, because too many people will invest based upon what has done well recently, where we think, it's almost like driving, looking through the rear view mirror is not the right approach. We want to make sure that we're looking forward to what's best, on the long term in the future. So good information from Morningstar, and just something to keep in mind if you have your own investment strategy in place. So one other comment I want to make, and this is something that we've shown on previous slides as well. This is the potential, or this is the expected return from Vanguard as of September 26, 2024. As mentioned on other presentations, we don't have a crystal ball, but we do kind of view Vanguard's outlook similar to our own. The two kind of key takeaways, I'll let people look at this, is that they expect the highest expected return going forward is international stocks, and the lowest expected return is U.S. growth stocks, which are companies such as NVIDIA, Alphabet, and Amazon, which are great companies, but might not be great stocks. So something to keep in mind about making sure you have a diversified portfolio, because you may not be focused on those areas that have not done as well over the last 5 and 10 years also. So with that, I'll hand it off to Colton, who'll talk a little bit about our investment strategy before we wrap up.
Yeah, so kind of referencing back to the Mind the Gaps study that Mike had just pointed out there, and this kind of just overviews our investment process and kind of removing that emotional decision making that you could tend to make if you were to manage it on your own. But first step for us is to develop that investment plan based off your time horizons of your goals and needs. So basic summary there is going to be bonds for the next 5 to 7 years, and then everything else towards stocks for long-term growth. Once we have that plan, we'll look to implement it by utilizing low-cost investment options that tilt towards factors of higher expected returns. And then finally, I think this is probably the most important part, is we'll oversee that portfolio to make sure that it stays in line with those targets. Additionally, we will rebalance when the opportunities arise and adjust the stock percentages in response to any kind of life changes, whether that's related to your goals or needs.
Right. Thanks, Colton. And that's a good way to kind of wrap up in that. If you do have questions as an existing client or you're considering working with Financial Symmetry, we're happy to walk through further a little bit more about our investment strategy, maybe about your portfolio and how we've decided to allocate that way. Any questions you have on the current market events, as well as you just want to look and talk to us more through our Talk to an Advisor link on our website about how we can help you and reach your financial goals. So finally, if you have any questions on the presentation or our investment approach, here's our contact information. We'd love to hear from you. If not, we appreciate you listening and hope to hear from you next quarter when we have the fourth quarter 2024 results. Thanks, everyone.